You buy a card for $200. 14 months later, you sell it for $400. On the surface, that looks like a great deal. You doubled your money. But after marketplace fees, payment processing, shipping, supplies, and everything else required to complete the sale, maybe you actually clear $350. You made $150 on 200. That is still a good return, but it also took 14 months. For 14 months, that $200 could not be used to buy another card, fill another order, test another category, or take advantage of a better opportunity. So, was it a good trade? Probably. Was it the best decision for the business? That is a different question. If you sell cards, you have probably experienced some version of this. Your inventory says you are doing well. You have cards worth money. You have made profitable sales. Maybe the total value of what you own continues to grow. But when a buying opportunity appears, or rent is due, or a large collection walks through the door, the cash is not there. You are profitable on paper and constrained in practice. I've experienced this myself, and I see it constantly with card sellers. It does not necessarily mean you are buying bad cards, and it does not necessarily mean you are losing money. It often means too much of your capital is tied up for too long, and you do not have a clear way to measure what that delay is costing you. There are two economic levers I think every card seller needs to understand together: spread and velocity. Spread is how much money you actually make when an item sells. Velocity is how quickly the money you invested becomes available to use again. Most sellers are already thinking about spread. You bought a card for $200, you sold it for $400, you made $200. Except you probably did not make $200. Your real spread is the sale price minus everything required to acquire, prepare, list, hold, and deliver the card. And that can include the purchase price, marketplace and payment fees, shipping and insurance, supplies, grading costs, the cost of a return or a failed transaction, and eventually the time required to photograph, list, answer questions, pack, and ship it. You may not assign a dollar value to every minute of your own labor yet, but the work still happened. So, spread is not the difference between what you paid and the number on the sales receipt. Spread is what the business actually keeps. So, velocity answers a different question, and that is, how long did the business have to wait to get its money back? A card can have a strong spread and a weak velocity. Another card can have a modest spread and strong velocity. The mistake is assuming the card with the larger profit was automatically the better use of capital. So let's compare two simplified examples. And these numbers are illustrative. The exact margins and timing will vary by seller, category, sales channel. You get it. But seller A spends $200 on one card. 14 months later, the card sells for $400. After the cost of the sale, seller A receives $350. The original $200 comes back along with $150 in profit. That is a successful sale. Seller B also begins with $200. Instead of purchasing one card, seller B buys 5 cards at $40 each. Each card eventually produces $8 in actual profit after the cost of the sale. That's only a 20% return per cycle, and it sounds much less exciting than doubling the value of a card. But suppose seller B can sell through and redeploy that inventory once every 2 to 3 months. Over the same 14-month period, that capital might complete 5 or 6 cycles. 5 cards producing $8 each is $40 in profit per cycle. Across 5 cycles, that is $200 in profit. Across 6 cycles is $240. Seller A made $150. Seller B may be between 200 and 240 using the same starting capital. Not because seller B found a more valuable card, not because every purchase was perfect. Seller B simply got the money back sooner and was able to use it again. Seller A may have made the more impressive trade. Seller B built the more productive inventory system. And those are not always the same thing. This is where the conversation usually becomes too simplistic. Velocity matters, but that does not mean every card should be liquidated as quickly as possible. Some inventory is worth holding. You may have a clear thesis around an athlete, a product, a market cycle, or an upcoming catalyst. A card may serve as a showcase inventory piece that helps establish what kind of seller or shop you are. You may deliberately carry depth in an important category so buyers know they can consistently shop with you. And some cards are simply part of your personal collection. They do not need to produce a business return at all. The problem is not holding inventory. The problem is holding inventory without knowing why. A strategic hold has a thesis. Showcase inventory has a purpose. A personal collection does not need to pretend it is operating inventory. But a card that was originally purchased for resale has attracted little demand, has no clear catalyst, and has sat untouched for a year is doing something very different. That is capital the business cannot currently use. And if you have enough of it, you can own a profitable inventory while operating a cash starved company. A useful first step is to stop treating every card you own as one undifferentiated pile of inventory. Give each item a job. I would start with 5 categories. Active inventory is merchandise you reasonably expect to sell within your normal operating cycle. Strategic inventory is being held because you have a specific time-bound reason to believe the economics will improve. Showcase inventory supports your brand, your assortment, or the experience you provide to buyers. Personal inventory is part of your collection and should not be counted on to fund the business. Stagnant inventory was acquired to be sold but is no longer moving and has no clear plan attached to it. That last category is the one sellers tend to avoid confronting. Not because the cards are necessarily worthless, they may still be valuable, but market value and usefulness to your business are not the same thing. You cannot pay an invoice with the estimated value of a card sitting in a case. You cannot purchase a collection with an unsold listing. And you cannot redeploy capital until someone actually buys the item. Here is the exercise I want you to run. First, export review all the inventory you consider part of your business. Second, identify the items that were acquired for resale but have not sold or generated meaningful buyer interest within the last 12 months. Do not include personal collection items. Do not include deliberate strategic holds unless you can clearly state the thesis and the point at which you will reevaluate it. Third, add up the amount of money you originally invested in the stagnant inventory. Use your cost basis, not the current asking price and not the highest recent comp. Then divide that number by the total cost basis of your business inventory. That gives you what I call your stagnant capital ratio. For example, if you invested $20,000 in inventory and $7,000 of that is sitting in items with no clear plan or meaningful activity, your stagnant capital ratio is 35%. That does not automatically mean you should immediately discount and sell at 7 grand. It means 35% of the capital assigned to your inventory is not currently participating in the operating cycle of the business. Now, you can make decisions instead of assumptions. Some items may need to be repriced. Some may need better listings or better distribution. Some should probably be bundled, and some might perform better on another channel. Some are going to deserve more time, and some need to be sold, even if the result is less satisfying than the number you originally imagined. Most card sellers ask, how much can I make on this card? That is an important question. But a business also has to ask, how long will my money be tied up? What role does this item play in my inventory? What evidence would make me continue holding it? And what other opportunity am I giving up while I wait? The goal is not to maximize velocity at the expense of every other consideration. The goal is to make the trade off consciously, because a card can appreciate, a sale can be profitable, your inventory value can rise, and your business can still run out of usable cash. A good trade and a good business decision are not always the same thing. In the next video, I want to put an actual cost on holding inventory, not because holding is always wrong, but because holding is never free.